18.4, acquiring additional capital. So today we're going to identify factors influencing financial decisions and analyze the impact of financial leverage. Making financial decisions, how a business elects to obtain funds for expansion or development will impact its earnings. Each method has a different impact on earnings. Borrowing money increases interest expense, and issuing stock may result in dividend payments. So when you're a company, you look at ratios. So the ratio of interest and dividend payments to the proceeds from debt and capital financing is called the cost of capital. A business should only raise capital if the projected increase in earnings is bigger than the cost of the capital. A business that elects to raise capital has several options. First of all, a line of credit, notes payable, bonds, common stock, and preferred stock. Each option can have positive and negative effects on a business and its owners. The following factors are considered in deciding how a business should raise capital. So we have the interest rate, the impact on the business's earnings, what the repayment terms are, how the ownership is controlled, and the debt ratio. We're going to go through each one of these 5 items in the next slide. First of all, the interest rate. A business seeks to minimize its interest expense, short-term versus long-term loans. If you remember when we talked about short-term loans in 18.1, they're relatively smaller interest rate versus long-term loans have a higher interest rate. So creditors demand higher interest rate if they loan money to a business with less than perfect credit history also. Another thing we look at is impact on earnings. Interest on debt financing is an expense that reduces net income before federal income taxes. But interest payments also reduce federal income taxes. The primary benefit of dividends is that the payments are made to the stockholders rather than creditors and bondholders. Repayment terms. Fast if purchasing items for a busy season. Slow if purchasing planned assets. Remember, if we're purchasing items for a busy season, we're going to sell those items very quickly and repay very quickly. If we are purchasing an asset for a plant asset, that's usually something that's very expensive and it lasts for a very long time, so your repayment terms can be slow. Ownership control. The existing owners of a business maintain full control of a business when expansion is achieved with debt financing. If funding is obtained through equity financing, a proportional share of control of the business goes with each new share of stock. This spreading of the control over business is known as dilution of control. So it depends on what your goals are there. And lastly, debt ratio. A business may not have total control over which financing method it selects. Creditors may be unwilling to lend money to a business with a high debt ratio. Such a business is perceived to be a high credit risk. The business may have no choice but to issue additional stock. In contrast, lenders are more willing to lend money to a business with low debt ratio. Creditors perceive such a business to be at low credit risk. All right, that was a lot, right? Financial leverage. Basically, the ability of a business to use borrowed funds to increase its earnings is called financial leverage. For financial leverage to be a benefit, the borrowed funds must be invested in the business and increase income by more than the interest paid. So let's look at a spreadsheet here. Okay, if we look at this, in the first column, the business earns an annual operating income of $4,000 right here. A return of 8% on its $50,000 purchase of equipment. Okay, hold on. I'll come back to that. There we go. That would be your return of an 8% on $50,000 purchase of equipment. After interest expense and federal income taxes, the business earns an additional $600. So here we have operating income, we have interest expense, subtract that out, and then federal income tax, subtract that out again. So $4,000 minus $3,200 is $800, minus another $200 is $600. However, the business only invested $10,000 of internal capital. All right, we lost our, there we go, right there. And therefore the business earns 6%. So to calculate that, because we need to know how to do it, we have 600 divided by 10,000 times 100, 6% on its investment. What if the company can earn $5,000 in operating income? That would be our return of 10% on the $50,000 purchased equipment. The second column shows the power of financial leverage. The return on the company's investment jumps to 13.5%. So $5,000 minus your interest expense is $1,800, minus the income tax is $1,350. Do this division, you have a return on investment of 13.5%. The interest expense is unchanged, thus the additional $1,000 of additional operating income belongs to the business. Earning a 12% return on the purchased equipment is shown in the third column. Okay, 12%, which gives us a 21% return on investment. It might appear that a business should always borrow money when it needs additional capital. That is not the case. Borrowing money can be risky. The fourth column here shows how financial leverage can be harmful. What if an economic decline causes the company to earn only $3,000 in operating income? Okay, subtract out the interest expense. We're negative $200, income tax on that. We are negative return on investment. A business can have too much debt. A business having a high level of debt is perceived to be a credit risk. A business having a high level of debt is said to be highly leveraged or possibly over-leveraged. So, selecting financing methods. A business needing to raise additional capital has many decisions to make. Does it use debt financing, equity financing, or a combination of both? Should equity financing involve common or preferred stock? The best choice is unique for each business. So, several years after opening its West Coast store, Sun Treasures is ready to expand again. It needs to raise $340,000 of capital to finance a third store and distribution center. The company will need $250,000 to purchase equipment and $60,000 to purchase inventory. The remaining $30,000 will be required to pay expenses prior to opening. Okay, so we've got a huge sheet in front of us. We're going to look at all of the financing options available and see what the company decided to do. So the board got together and decided to take the following actions to finance the expansion of the business. First of all, it's going to draw $18,000 on its $50,000 line of credit. This debt financing source has the lowest interest rate, which is 6% of the 3 debt financing options. The new balance of $32,000, so this is our line of credit. We're going to draw $18,000, which gives us a new balance, so these two added together, a new balance of $32,200. And that will preserve the board's target emergency balance of approximately $15,000. Okay, the next thing the board's going to do is sign a $160,000 7.5% note payable on the equipment. The interest rate on this debt is higher than the interest rate of the bonds, Sun Treasures projects that company earnings will enable the loan to be repaid within 4 to 6 years. The board elected to pay a slightly higher interest rate for a few years rather than be obligated to pay interest on additional 6.5% bonds for 20 years. Remember, bonds last longer. So slightly higher interest rate, but a much shorter payment period. The next thing we're going to do is sell $4,500. We're going to sell 4,500 shares of common stock at the current market price of $36 per share. The stock will generate the remaining $162,000 of financing. So first we did debt. This is our line of credit, notes payable, and then we're going to issue some stock. So if we look down here, we have $178,000 of debt financing and $162,000 of equity financing. That gives us what we need of $340,000. The debt financing alone would raise the company's debt ratio to 65.4%, and the board doesn't like that. They have a goal, a benchmark of 60% debt ratio. They don't want to go over that. So equity financing had to be into the mix to keep the debt ratio down. Let's see if there's anything else I need to. Cool. All right, so the total number of shares outstanding will increase to 94,500. To hold on to a majority of the outstanding shares, the founding family has elected to purchase 1,000 of the shares. So the family will hold on to a majority of the outstanding shares. The family will then own 52.4%, right here, 52.4% of the outstanding shares. A family united in its decision can guarantee its control over the corporation by owning a majority of the common stock. After equity financing, the debt ratio is, right here, 50.5%, which will be within the benchmark range of 40 to 60%. That's its goal, which is very cool. So here, before it did all of the debt financing and equity financing, the debt ratio was 48.8. It just raised to 50.5. The owners were at 53.3%. It dropped to 52.4%, but it's still a majority. Identify 5 options available to a business to raise capital. Lines of credit, notes payable, bonds, common stock, and preferred stock. Identify 5 factors that a business should consider in deciding how to raise capital. Interest rates, impact on earnings, repayment terms, ownership control, and debt ratio. What is necessary for financial leverage to increase earnings? The borrowed funds must be invested in a business to earn income higher than the interest charged on the borrowed funds. And how might individuals describe a business having a high level of debt? Highly leveraged or over-leveraged. Not good. What might force a corporation to issue additional stock? The debt ratio of the corporation exceeds its debt ratio benchmark, just like the example we just went through.